hundreds of them. And what we did is just group them together, the similar ones, and place them in different categories, about 5 categories. I asked the team to put it all together, and we also put the names of those people who asked, so that some of these guys might be asking the question. But before that, I'd just like to clarify the GMADI. I think it was shown in the video earlier that your minimum 50,000 pesos. It's not the minimum for GMADI for this fund is only 1,000 pesos through the COL platform. Just in case any of you are interested, or this, it's very low, so that it's really now democratizing. People with just 1,000 can access these global markets, these options writing, this high yield that Paul is talking about. So, okay, let's go to the, I hope I clarify that. Let's go to the advanced questions, team. Let's look at the first one, where we have comparisons and alternatives. Asked by Daphne, what makes this different from other funds that you have? How is it different? And
So the real difference is this is a pure income focused portfolio. So it's really for clients looking for high single digit income into their portfolio. And also you tend to have, because you're focusing on income, it tends to be a little bit more defensive in its portfolio construction. So you're getting, say, for example, other mutual funds, equity funds, for example, they've got a pretty high volatility rate, as you can imagine. The vol is probably 15, 20%. The GMADI fund vol is probably around 10. So, you know, you're getting a 5-6% payout on a vol profile of 10. And we find that pretty compelling, especially in the environment that we're currently in. And, you know, I think there's a real conviction that we have at Manulife around income investing. We've sold a number of income funds for our clients looking for income. They want to find ways to capture a lot of these high rates that we've got in these markets. And so this really is for clients looking specifically for income, and do want to complement this with this portfolio with their existing portfolio that may be a little bit more risk on, more total return oriented, whereas we want to focus on pure income only and do it in multi-asset income as well.
Okay, Paul. Now on the other questions, allow me provide me the indulgence to be the one to answer this. So how you compare it to REITs, asked by Lemuel, and then there's a question on the stocks yielding about 6% like SPC. And if there's even a question here on MP2, you're not familiar with that. We have that in the Philippines of Pag-ibig. Allow me to answer this. No, so Paul has already explained that the GMADI, the fund, is really diversified globally. That's the #1 difference compared to all of these questions that you have. The REITs, the stocks are only invested in their own assets in locally, so it's not really as diversified. And if you compare it to the MP2, the MP2 of Pag-ibig is 5 years holding period, no? And it's invested in, it's a very good yield, dividend yield also. I wouldn't say it's very good, 7 to 6% net for, and even government guaranteed. That's also a good investment. But again, it's not globally invested. You're not participating in these other markets in the world, and so that's a basic difference. It's also giving you good yield. Now, on the last question here by Eleanor on this category, can I switch my other Manulife insurance to this fund? I guess allow me to answer that as well, Paul. Manulife insurance is an insurance product, so there's a life insurance component to it, and then you can actually sell that and buy this fund for your income generating. But again, you lose your insurance protection if you are selling the Manulife insurance. But for this fund, it is a UITF. It's a fund. It doesn't have insurance backed in it. And again, I guess the last comment I have is that I suggest that you get in touch with your agent, the one that sold you the insurance, and they can help you with that. All right. For the next category, can we go to the next set of questions, guys? So distribution and payout policies. Paul, is this fund structured to provide monthly dividends, or is there a chance that the payout frequency could be reduced over time? Meaning it's not going to be monthly. Is there a possibility that it's not going to be monthly? Oh,
Oh no, it will always be monthly. That's embedded into the portfolio
okay.
features. Yeah.
Okay, okay. Let's good. Answer it shortly so that let's keep our answers short so that we can
Yeah.
answer a lot of questions. What is the current payout ratio? How is it expected to change in the coming years? You said that it's about 6%, more or less, right? Yeah.
Yeah, I mean the target fund is a little bit more in the Luxembourg fund, but I believe your local fund is sort of 6.6 in terms of the payout. So how is it going to be expected to change in the coming years? Again, I think we talked about it previously on a slide before where we had rates at zero and we were still paying out sort of mid high single digit payout. So, and again, I'm a member of that committee as well. I don't see the payout dropping significantly at all. We want to make sure this fund is competitive versus our peers. And so we're very mindful that cutting rates, cutting the payout is detrimental to the philosophy of this portfolio. So
Good.
yeah, we're expecting the payout to maintain its consistency near term. Yeah.
All right, thank you for that. These next three questions on the right, by Randy, Maria Teresa, and Angelo Miguel, I think this more or less related. I think they're really concerned on the getting the dividends, how sustainable. What are the factors that affect the amount of dividends if I buy the fund at the lower price? And then what's the probability that dividends will be paid out from the capital? Is that a concern, Paul?
Yeah. So there is technically yes, but I'll give the reasons why. So in a portfolio of bonds and a portfolio of equities, when you own a bond, it doesn't pay out monthly, right? This fund pays out monthly though. But when you own a bond, the bond might only pay your coupon quarterly or semi-annually. When you own
Mhm.
an equity, the dividend might only be paid quarterly as well, not monthly.
Okay,
So
okay.
technically, there might be a month that we've not received the bond cash flow because it's coming in the next 2 months for the quarter. So
Uh-huh.
technically, there might be some months where you'll see it coming out of capital, but over the
Mhm.
course of the year, this should catch up with itself as the quarterly coupons are paid, as the dividends are paid quarterly or semi-annually. And what we don't want to do is pay out all from capital over time. So there is a real focus on making sure we achieve a natural income from the fixed income coupons, from the dividends, and from the option premiums.
Okay,
Um,
okay.
so
Yeah.
yeah, that's the crux of the thing. So technically, yes, it can sometimes happen, but it's just a sequencing of payouts that we should get it all back over the course of the year.
Yeah, yeah. I think, Paul, you're saying on the cash flow side. So cash
Yes,
wise,
timing of cash flows. Yeah,
yeah, you can take it out from the capital. But again, that is under the understanding that you know that you will be receiving
yeah,
uh, a dividend, coupon
coupon.
payment that's
Yeah,
giving you that kind of a yield that
yeah,
allows you to pay now
correct,
as you're going to accept it or receive it sometime in the future on a
correct.
semi-annual report, I should
Yeah,
say. Great,
exactly.
great.
Yeah.
Good. So I hope that is clarifying it. The last one is to expect the dividend or next one. Okay, market outlook. Yeah, market outlook. What is our outlook for emerging markets like India, China, and the Philippines? Do you have that, Paul? Can you just give us a short?
Yeah, I mean, we're warming up to some of these markets, particularly Asian markets, maybe less so broader emerging markets, but we do have an overweight, for example, on countries like China. Again, we feel there's a flaw that has been made with China policy. There's areas within China that we currently like, and that maybe through China tech, there's some areas there that we like, and the competitiveness is of China tech versus its US counterparts. And so there's potentially a tactical cases to own that market as well. In India, we also like, but again, it's one of those that has been a trickier market to capture this year. We've had obviously some war breaks out with, well, not a war, but sort of battles with Pakistan, which has impacted the market. But what we do like with India is tapping into some of the middle class consumer there. So those middle classes who want to travel. So we do like some of the online travel agents in India. We do have some of those in our portfolios. So yeah, some of these markets we quite like. I mean, with the Philippines as well, we've obviously had the BSP cutting rates, I think, in April. We see sort of CPI moderating as well in Philippines. We see growth as pretty resilient, but we don't necessarily see huge upside to growth in Philippines. And then we also see compelling valuations. So In terms of the Philippine market, I think it broke the 6,000 level, but it's recovered pretty well since then, and it's back to sort of pre-liberation day levels. And so, I think that reflects reasonable improving sentiment in Philippines. So, yeah, we don't have necessarily an overweight there in Philippines, but China and India are areas that we do like in our more Asian-oriented portfolios. Yeah.
Yeah, thank you for that, Paul. Just in case, no, Dre, thank you for that question. We also have a fund, particularly Manulife in our COL platform. We have an India fund, and we also have a China fund, the Dragon Fund. Just in case you're interested, you can get that information from our website. But this particular session is really for the income paying. Those two funds are equities. I guess those are the ones that you can look at. On the other questions by Bianca, Laila, and Arnel, I think Paul, their concern is really the US. And GMADI, naturally, because US is the largest market in the world, this fund is invested and in terms of asset allocation, a lot in the US. The
Yeah.
first question here is, do you consider adjusting the weight? And are you
Yeah.
concerned about the tariff and this thing that's affecting investment in the US that affects the fund?
Yeah, so there's been a big discussion about what's often been called US exceptionalism or the end to US exceptionalism. I'd be cautious about using that and just thinking US assets are sort of dead or the US dollar is dead. We don't think that is the case. The US market is a pretty resilient market. And then sort of when you look at the US, you still have rate cuts on the horizon, you have tax cuts on the horizon, you have inflation coming in lower, and you have these big sort of Trump deals that are taking place. And so, the US market, I don't think is a you shouldn't just sort of fade away from it. But saying that, we definitely have moved more into non-US assets in the GMADI portfolio over the last, say, 4 months or 5 months.
Uh-huh.
Um, Buying non-dollar assets, moving our allocations into Europe, moving allocations into Asia credits a little bit more. We've added more to that area as well. So yeah, there's definitely been some movement away from the US and buying EFA, as the Americans call it, which is sort of the European markets and the Asia markets. So yeah, I'm not saying we're going to do a huge shift. I don't think they've made that decision just yet. Earnings growth out of the US came in at 12% for the first quarter, which is still very, very good. And so we're sort of tackling and with the idea that is the gap between the US and Europe narrowing? We think it is, but we still think US still maintains sort of a good profile in terms of earnings growth and policies to help keep the US pretty resilient. So yes to this, we are adjusting weights towards non-dollar assets somewhat, but we're not ruling out the US.
Okay. Yeah. At least you have reduced your exposure in the
Yeah.
US. That's comforting. Yeah, great. Moving to the next category. I think this is the fund strategy. Question by Ritz: how often do fund managers change or switch the invested assets? How like you're shifting from US or other, how fast does that move in terms of asset allocation? Just give
So
me.
yeah, so if you're a client and you're just looking at the equity fixed and option components, then those top level numbers probably won't change that much. But when you look underneath the equity bucket, for example, and the sectors that it has exposures to, that moves quite, I'd say, reasonably dynamic. It's not a fully tactical portfolio as I'm aware of other tactical portfolios, but it has an element of shifting between certain sectors. So, for example, we're currently and have been underweight tech sector for a while, and we have overweights in areas like healthcare, financials, and consumer discretionary. And so, yeah, there'll be changes within that portfolio. I guess on a sort of bi-weekly basis, they'll make some action points at some point in the portfolio. If there are new issuances on the fixed income side, they will monitor those particular issuances and see if they're attractive enough to add to the portfolio. And then the option writing, that part of the portfolio is done every month. So every month we would stagger. Well, actually, it's not technically done every month. It's staggered weekly, but on a monthly option expiry period. So yeah, the different parts of the portfolio may move quicker than other parts, but yeah, there is an element of making sure we express views into the portfolio as quickly as possible that reflects a high income outcome. So we're marrying our views towards income. So that's the bias in the portfolio. Does that bond give us good sustainable income over the next sort of 6-12 months? If so, does it add risk to the portfolio? We maybe think not, and so we'll start adding some of these bonds into the portfolio. So yeah, it's fairly frequent depending on what part of the portfolio you look at.
Great, great. I like the question here by Victor and two others. No, I think just talking about the risk.
Yeah,
How, because when market moves, sometimes it moves the same way, like the bonds and the stocks. Sometimes they correlate, right?
they
And
do.
how do you manage that risk?
Yeah,
How do
so
you manage
without
that risk?
yeah, so without going too technical here, behind the GMADI portfolio, you obviously have a very strong global multi-asset team. And within that team, we would look at volatilities, correlations, and expected returns on asset classes. And there's a formal process around that team coming together every quarter and looking and reviewing asset classes, correlations, and volatility. If there is, as you say, a alignment in correlations between asset classes, then this would therefore feed into our multi-asset portfolios, and the team would either dial down exposures in certain asset classes to ensure correlations are either mitigated somewhat or they're not all going the right way. One thing I should point out is on the option writing, they're actually negatively correlated income profiles. I think, as I mentioned at the beginning of the call, when markets go up, you lose the call writing, but you get all the put writing. When markets go down, you lose the put writing, but you get all the call writing. These are negatively correlated income profiles. And so, again, you're right. We want to have low correlations between these asset classes in our portfolios. And so having a multi-asset income type structure, we feel mitigates or reduces the correlations between fixed income equities, between preferred securities, with REITs, with IG and option writing, and we can really sort of manage those correlations and manage the vol profile of the portfolio.
Yeah, right. So you have a team that watches all of these things. So
Definitely, yes.
the benefit of that. Great, great. I'm moving on. I think you've answered the question by Joe. This Patrick, this is asking for projections of the funds, but maybe Paul, what you can do in Manulife American Global Dynamic and Global Equity. Maybe just give us a view of your that this asset class. What's the I don't know. I don't think you make projection, but maybe the view for the year.
Yeah, I mean, this is probably, if you think about, depending on what type of sort of bias these portfolios have. I mean, when you think of US equities or global equities, or say here American equities, there might be a value or a growth bias in these portfolios. We're reasonably constructive, I'd say, on US equities. I think we've talked about it before. There are some positive tailwinds potentially coming through. And so again, I wouldn't rule out some of these portfolios that do have a US bias. I said it before, there are tax cuts to come. There are potential for rate cuts to come through. We have policy support from the Trump administration as well. And so yeah, again, we're reasonably positive on some of these US assets. I should say though, after this bounce, and this is just sort of a tactical view, there could well be, we could well be in for a couple of months of consolidation. We've had a huge bounce off these lows. We've had a big turnaround in market views on tariff risk, which has now mitigated somewhat. And I think we're due a period where we come into the sort of summertime and we get a bit of consolidation. So yeah, I think that could happen near term. But as we approach the sort of summertime, rate cuts become a bit more transparent. I think we get back to markets progressively moving a bit higher.
Good, good. All right. So again, can we move to the next? I think some of the questions have been answered already. Investing guidance. I think the question of Wilfred and Jean, let me answer that. The one on the right, maybe look at this poll and you'll answer it later. The question of Wilfred, I have a Manulife VUL policy tied to peso bond. Can I exchange it for this income feeder? I think the question is not directly. I think I answered it earlier today that the VUL, variable unit link, you need to ask your agent. You can redeem this, but again, you lose the protection on the insurance side because when you buy this feeder fund, this Manulife GMADI, it doesn't have an insurance, but it is a fund. It is a unit income fund that is giving you regular income. You can actually ask your agent on how this is done. Now, the question of charges by Gene, are there any charges when we invest? Of course, there is a management fee that is being charged by the fund, but this is already net. As you see, the yield that you get about 6% net. That's net of fees already. So that is we disclose that in our fact sheet and in the fund fact sheet in our website. All right, moving on to the questions on the right, Paul. I guess the question here is really on the fund itself, no? So despite average projection, why is it currently -3? Is this just temporary? Larry.
Yeah, I'd like to understand, Larry, where that's from. I mean, the current portfolio is paying out 6% plus in terms of its income payout. The target portfolio is positive year to date. So I'm not sure what we're looking at in terms of the management, and I'm happy to help Larry with
Maybe
further
different. Maybe that happened when the data is looking at when the market went down. So I guess
Sure, yeah. I mean, yeah,
there are times when the market goes down and the fund
yeah, I mean, yeah, I mean, okay, so yeah, it was negative at some point during the year-to-date period. It's now retraced a lot of that, and it's recouped a lot of those negative returns. It's back to positive returns year-to-date. Look, there is risks here. You pay for the risk that you invest into, and that's the risk that we take. You may have periods of negative performance. When you have a volatility of 10%, like you have in this portfolio, expect volatility of 10%. So if you're buying an equity fund and you have a vol profile of 20%, expect potentially to have negative 20% equity returns in an equity fund. So we try and highlight to clients to let them know what they're getting into and try and be transparent. This is the profile of this portfolio, and you should expect over periods of time there will be some negative returns, but we're hopeful that we can get those returns back over the market cycle. So yeah, there was a period where we went through maybe early part of the tariff anxiety in sort of late March, early April, but we've recouped them year to date. Yeah.
That's right, Paul. So I guess that answers the other two questions. What are the potential risks? I guess when you sell it at the time when the market is down, because of the volatility of 10%, that there's a risk that you can lose your part of your capital, but right, and then you just get the dividend. But when you sell it at the time when the market is down, then that's the risk that you.
There is, but I could just put onto that. If you look at the GMADI fund has got a 6-year track record. So over those 6 years, if you go back 6 years, you've had some pretty volatile times over those 6 years. The 5-year track record for GMADI is annualized sort of 6-7% returns for the target fund. So what I'm saying here is that despite the volatility you've had over the last 6 years or 5-6 years, you've still had a pretty good mid-single-digit return profile annualized over those 6 years. So the sort of key message here is to expect the unexpected, but remain invested through these market cycles, and over the longer term, we feel we can produce those results for our clients.
Great. So let's move on. We have just the last category before we move on to the live questions in investing guidance. From Felipe, how is the investor dividend yield income computed? How do you do that, Paul?
We get an idea of how much income we're going to generate from the fixed income side. We can see that through the bonds that we hold in the portfolio, and we get an idea of how sustainable that corporate is paying those coupons. And we really want to invest into corporates who have more transparent cash flows. And so that's one thing. Dividends as well. We can look at historically how our equities have produced dividends historically, and we can gauge the dividend policy of these companies by meeting with them. We meet and speak to thousands of companies every year, and we get an idea of how their dividend policy is going to be over the next few years. So that's how we sort of understand what income we're going to be getting from fixed income and dividends. And same on the options side. These are priced. They're priced off volatility. There's a price every day, and we get an idea of what income we're going to receive from the option premium. So it really is about market pricing, and that gives us a very good day-to-day idea of what dividend yield we're going to be getting into the portfolio. Then it comes to how much do we pay out to our clients? And obviously, we don't want to be paying out more than we're receiving.
Yeah.
So we have a committee around that and make sure the governance of the fund is sustainable over time, and we're paying out the right amount of money from what we're receiving into the portfolio.
Okay, okay. In terms of the tax, allow me to answer that. Philippine laws, the UITF that you're investing in, is the gain that you get from the UITF is not taxed. So I think the tax is where the underlying it. For example, they bought a bond that has a tax that's already depending on the assets that they invest in. That's depending on which tax year. But the gain that you generate from the UITF, this fund, is not taxed. All right. And the other questions, allow me to be the one to answer this, Paul. Deciding the switching of funds, and then the next question by Leo is based abroad. Okay, in switching of funds, you have to remember, Bernadette, that the funds that you buy in is really for a purpose. Any investment that you do is really for a purpose. This fund is for income fund, meaning you want to generate income on a monthly basis. That's the purpose. If you want growth, it's the equity fund. You just want a simple money market fund that's safe. That's also good. Considering switching it depends on where you are, what you want to do, or what's the objective of your investment. I guess that's how you answer this. The next one, if you're abroad, by Leo, if you're abroad, what can you do? Later on, I will tell you how we can access. You can buy it through our platform in COL. Even if you're abroad, you can buy this fund. For as long as you're a Filipino, you can buy this fund. Now, next by Ricardo. With a small amount to invest, how would you advise individuals it's better to start investing now rather than later? Would you advise cost averaging? Cost averaging is ideal. I guess, Paul, you might also chime in there. You think that's an ideal strategy for GMADI?
I mean, first of all, I don't know Ricardo's age, but often we get clients who sort of in their 40s, 50s who maybe thought we should have invested earlier at a younger age and taken a bit more risk. So for me, yes, cost averaging is important. You have to think about investing as a long-term lifestyle plan for you, not just, and try not to get caught up in the day-to-day headlines that you see and hear on TV, which can often be panic people. And I think if you're sort of calm and looking to invest every month, for example, that's a reasonable approach to take. And therefore you can take advantage of volatility when things do fall, you're buying in lower, and you can keep doing that. And over time, you probably get a nice wealth pot, accumulate capital, and then have a nice retirement off it, hopefully over time. But if you were of an older age, then it's a bit different. Depends where you want to be and where you want to sort of take your retirement and your lifestyle in retirement. So again, I can't sort of fully make the call on what's best for your particular profile. But yes, I mean, monthly investing into GMADI or into any investment portfolio is a good approach, I'd say.
Great. So I would imagine, Ricardo, if you're young, I may even suggest the dividends that you get from GMADI, you reinvest in GMADI. Right? The monthly dividends you get, you just reinvest it. And then you do your cost averaging. That would be ideal for you, especially when you're young. Now, the last question by Bernardo here is the fees. Does it diminish the value? I guess it does, right? But you've done well for the past, you said, past 5 years, 6 to 7%. That's right, Paul?
Yeah, I mean, ultimately we want to create excess returns that include the fees or pay off fees as well for our clients. That's the aim. Again, if you may find originally when you go into some of these portfolios and you do sort of start to invest on a particularly weak point in the market, then it's going to be tricky. But again, investing should be thought about long term, looking towards your retirement, looking towards for your family and to securing things for your family as well. And therefore, you know, our expectations are to give the payoff that we say we're giving to clients, and also cover those management fees by offering those returns back to our clients. Yeah.
Oh, wow. It's already 5 o'clock, Paul. I'm sorry, I might have to extend you. We said that the invitation only 45, but is it okay? Let's extend so that we can do
Sure.
the live questions here. Guys, let's get live questions here from the audience so that we can answer them one by one. Okay, through the Slido. Okay, this is a question by Lai. Is Manulife multi-asset fund designed to continue to provide dividend monthly, or it will come to a point where there will no longer be dividends?
No, I think we've answered this question already. It's always going to be monthly. There's no change there.
Yeah.
And there will always be a payout. And I think we've evidenced that with the chart before that show we paid out mid-single digit returns when rates were zero. Rates are not at zero. They're at sort of whatever that 5+5. They've gone up 550 basis points. So yeah, I mean, we're still expecting mid-single digit returns for our clients, and that's the message we give to all our clients who invest into the GMADI portfolio. I'm pretty confident we can keep that going when rates are higher for longer, and we'll tap into and capture those rates going forward.
Yeah. Okay. Well, let's take other questions. Preferably the ones that has not yet been asked. Preferably, no? Guys, let's look at all the live questions that have not yet been asked. On the Slido. It's quite interesting to see that there are a lot of questions that we're getting, you know. And now that yeah, okay, all right. By Cherry, what do you mean by option writing? Please elaborate. So I guess this is something new for Filipinos, for retail investors.
No, I mean, we often get asked to simplify how we express what option writing is. And often what happens, we try and simplify it, but our clients want more information about it. They want to learn more about it, which is great. But actually, when you start delving into it, it can get quite complicated, and they end up asking, well, let's just simplify it again. But option writing is just a term, means you're selling options. That's what option writing means. You're selling options. You're not, if it was just buying options, you'd be buying options. But option writing is just a term that means you're selling options for a premium. So that's what we're doing here. We're writing options on the S&P, and we're expecting that S&P not to reach a certain level. So we're say, for example, we write a call on the S&P at 6,000. If the S&P breaches 6,000, then we owe money to the buyer of that option, and we don't get the premium. If the S&P finishes at 5,500, we keep hold of that premium. So that's what we're doing. That's what option writing is. And you could probably go on your Investorpedias, and they'll give you a sort of a good summary definition of what option writing is and what it entails. But here it's selling options and getting a premium for it. Okay, another simple way of thinking about it is it enhances yield generation for the GMADI portfolio. That's what we do with option writing.
Yeah. It's like a contract. No, this is maybe to add to policy. It's a contract with some other counterparty. The guy who thinks you differently, you know, right? So you think
there's a buyer of that option. Yeah, I mean he wants to either have upside risk, or he wants to mitigate downside risk. That's what the buyer's doing. He's paying us to mitigate downside risk for him, and so we'll get a premium to do that.
Yeah, but basically they pay you something for doing that. So that's
each month.
That's part of the income that you generate.
Yeah.
Okay. I think any other question without because you know, Paul, as we were talking in the chat room, we asked all the analysts, our fund analysts, and even somebody from Manulife to answer the questions. I think they've done a good job answering all those questions, and I think this is one of the last few questions that have not yet been addressed. Good to discuss this by Adrian. For this kind of fund and considering current conditions, is the advice to tranche more conservatively or aggressively over the next 1 to 2 years? How much volatility to expect from the fund over the medium to long term? Basically, he's asking what kind of strategy in buying this. Are you going to do it now quickly or conservatively over the years? How much volatility? Yeah.
I mean, we do have a chart which sort of often when we think of the future, we want to look at how the portfolio has performed or behaved over the last 5-6 years. And when it comes to volatility,
Maybe you want to show that. You maybe want to show that.
Okay, we can
maybe as part of your
if we can flick to that. There's a performance chart between different peers.
That would be interesting.
Maybe that'll help Adrian with the response. We should down this chart 13 year. So what we've got here is a profile of GMADI on the left side with the blue boxes around it. The right hand side of the chart are non-Manulife peer funds that you can buy in the Philippines through relevant banks and distributors. So we've compared ourselves to them. And so when you're talking about volatility, if you go down to the 5-year volatility, you're about 9%. I said around 10% was the vol profile. So that's what we'd expect as the vol profile of this portfolio going forward. You have other peers that are generating sort of 10, 11% volatility, but either their payout isn't as much or their performance isn't as great. And so you can really get a flavor that, say, the 5-year performance of GMADI, it's about 7% annualized. So again, we'd be looking for a similar profile going forward, particularly given the payout of GMADI is around 6% as well, which has done pretty well versus peers. But you've got to remember what are the risks in the portfolio as well. And we've achieved that 6 to 7% annualized payout with lower risk. Looking at the vol profile, you can see it's a lower vol profile versus our peers. So what we call risk-adjusted returns, these are the returns you get from the risks that you take. These look pretty competitive versus our peers. And so this is again, if a client asks what sort of volatility would we expect around 10% vol. So we could draw down over 5 years, have a period of a 10% drawdown in this portfolio. But as you see from the 5-year performance, we've generated 7% annualized per year, and we've paid out about 8% for the target fund. But I think, as we talked earlier, the local fund is about 6.5%.
That's right. That's right. So lower volatility, even higher performance, and then the performance you're saying here, the 5-year performance, are the fund's performance, no? That is already on top of the fees, on top of the dividend that you paid, or including.
It's including, it's included. Yeah, it's included. Yeah.
Okay. The dividend distribution of about 8.6. The 8.6 distribution yield, how is that different from the 6% that we've been talking about?
Oh, so this is the target fund we're talking about here, and the one you talked about earlier in the call was the local fund, which is 6.6. I think there are some local regulations that you can't pay out more than what you achieve in the portfolio, which is a Philippine regulatory rule. With the target fund, however, we can pay out a little bit more because we can potentially get capital appreciation being used as that payout. So we get a little bit more, I'd say, leniency in terms of the payout of the Luxembourg fund that we currently sell. But the target fund is a little bit more strict on the payout. That's why it's only around 6.6% in terms of.
And then I think this is gross of fees, right? This is
yes.
Gross of fees. The one, the 6.6% is net fees. I think that's what we're talking about. But it's very good yield. Oh, okay.